When it comes to taxes, the IRS, Internal Revenue Service, can seem like an all-powerful force looming over every financial decision. While the agency plays a significant role in the American tax system, it's crucial to separate fact from fear. The IRS has broad authority to collect taxes, enforce tax laws, and issue penalties, but there are very real legal limits to what it can do. Understanding what powers the IRS actually has, and where its authority ends, can help you navigate tax season with greater confidence and peace of mind. This video explores the top 10 things the IRS can and cannot do, equipping you with the knowledge to protect yourself and respond appropriately to any IRS-related issues. 1. The IRS can garnish your wages with notice. If you owe back taxes and fail to pay or respond to IRS notices, the agency has the legal authority to garnish a portion of your wages. This means it can contact your employer directly and require them to withhold part of your paycheck to satisfy your tax debt. However, the IRS must first send you several notices, including a final notice of intent to levy and a notice of your right to a hearing. This garnishment does not happen suddenly or without warning, giving taxpayers time to respond, dispute, or set up a payment arrangement. 2. The IRS cannot arrest you just for owing taxes. Owing taxes, even a significant amount, does not automatically mean you'll be arrested. The IRS is not a criminal law enforcement agency and does not arrest individuals simply for having unpaid tax bills. Arrest and prosecution typically only occur in cases involving criminal tax fraud, such as intentionally falsifying information, failing to file returns for multiple years, or participating in tax evasion schemes. Most taxpayers facing IRS debt are subject to civil enforcement actions like garnishments or liens, not criminal charges, unless willful wrongdoing is proven. 3. The IRS can freeze and seize bank accounts. When a tax debt goes unpaid and the proper legal steps are taken, the IRS can seize your assets, including funds in bank accounts. This is known as a bank levy. After issuing several notices and giving you the opportunity to resolve the issue, the IRS can contact your bank and instruct them to freeze your account. Typically, the bank must hold the funds for 21 days before turning them over, giving you a last chance to contest the levy or settle your account. It's a powerful enforcement tool, but not one the IRS uses without due process. 4. The IRS cannot enter your home without permission or a court order. Despite its authority, the IRS cannot simply barge into your home to demand payment, seize property, or search for documents. If an IRS agent shows up at your residence, they must have either your consent to enter or a court-issued warrant. Taxpayers are under no obligation to let agents into their homes unless legal requirements are met. Even in collection cases, the IRS follows a structured legal process and must obtain court approval before taking extreme enforcement actions involving private property. 5. The IRS can file a federal tax lien on your property. A federal tax lien is the government's legal claim against your property when you neglect or fail to pay a tax debt. The IRS can file a public notice of this lien to alert creditors, making it difficult for you to sell property, secure loans, or refinance assets. The lien attaches to all your current and future assets, including real estate and personal property. While this doesn't result in immediate asset seizure, it serves as a warning and can damage your credit significantly, pushing many taxpayers to resolve debts more quickly. 6. The IRS cannot suspend your passport without State Department approval. The IRS does not have the authority to revoke or suspend your passport on its own. However, if you owe more than a certain threshold of seriously delinquent tax debt, over $62,000 as of 2025, including penalties and interest, the IRS can notify the U.S. State Department. The State Department then has the authority to deny your passport application or revoke your current passport. This collaboration is real, but the process involves multiple steps and legal protections, and it requires a certified debt, not just any unpaid tax amount. 7. The IRS can audit you, but must follow strict rules. The IRS has the right to audit tax returns to ensure compliance with tax laws, but it must follow strict procedures. You have legal rights during an audit, including the right to representation, the right to know why you're being audited, and the right to appeal any decision. Most audits are not the dramatic, in-person events people imagine. Many are done via mail and only request specific documents. The IRS generally has 3 years from the date you file a return to initiate an audit, unless fraud is suspected, in which case the window may extend indefinitely. 8. The IRS cannot penalize you without explanation or appeal options. Penalties from the IRS, including those for underpayment or late filing, must be clearly communicated and include explanations for why they are being assessed. You also have the legal right to challenge any penalties or interest through appeals. The IRS must provide you with notices and the opportunity to resolve or dispute the issue. Additionally, programs such as the first-time penalty abatement offer relief to qualifying taxpayers. The IRS cannot impose arbitrary penalties without informing you of your rights or allowing you to respond. 9. The IRS can offer relief through installment plans and settlements. If you owe taxes but can't pay the full amount, the IRS does offer several options to help you resolve your debt. These include installment agreements, monthly payment plans, and offers in compromise settlements for less than the total amount owed. While not guaranteed, these programs exist to provide relief to taxpayers facing hardship. You must meet eligibility requirements and provide detailed financial information, but the IRS can, and often does, work with individuals to avoid overly aggressive collection tactics. 10. The IRS cannot ignore the Taxpayer Bill of Rights. In 2014, the IRS formally adopted the Taxpayer Bill of Rights, which outlines 10 fundamental rights that every taxpayer has when dealing with the agency. These rights include the right to be informed, the right to quality service, the right to pay no more than the correct amount of tax, and the right to appeal an IRS decision in an independent forum. If the IRS violates these rights, taxpayers can file complaints with the Taxpayer Advocate Service, seek legal help, or pursue further recourse through administrative or judicial channels. The IRS is a powerful agency with a wide range of legal tools to enforce tax laws, collect unpaid debts, and ensure compliance. But it is not all-powerful. There are limits to what the IRS can do, and it must operate within the law, respect due process, and uphold taxpayer rights. Knowing the difference between what the IRS can and cannot do helps reduce fear, encourages proper compliance, and empowers you to respond wisely when facing tax issues. Whether you're filing a return, resolving a debt, or being audited, understanding your rights and the agency's limits is key to navigating the complex world of taxation with clarity and confidence.